Welcome to Financial Education for the Nation. My name is Warren Shute, and I'm here today on my own. Paul's not feeling too well, so everyone give a big shout out to Paul. Hope you get better soon. There's lots of colds going around. So I'm doing it myself on my own today and come outside because the weather is tremendous. I'm having a great week of weather this week. It really improves your morale and how you feel, and everyone seems to be a little bit more upbeat in their step in how things are going. And I wanted to change the demographics a little bit this week and talk about equity release or lifetime mortgages or reverse mortgages, or some of you might be aware of them. And this is really aimed more towards the older generation, probably hitting sort of late 60s, really. You can get them for younger individuals, so in your mid-60s, going through into later life. Just want to explain how they work and what they are, why you might consider them, what the benefits of them are, and just give you some sort of pros and cons around it. So as always, give me a big shout out, give me some questions. It's really good for you to ask me questions so I can answer your questions. This actually came on the back of a listener's question as well. He or she was, they, should I say, were deliberating whether it was the right thing to do. So what is equity release? Equity release is when you take a mortgage out on your property, but rather than pay monthly payments, your monthly payments are added to your mortgage balance. And then those payments roll up, interest is charged on the original borrowing and your interest that you're being charged, so it's compounding interest. And then when you move out of your property, whether that is when you pass away or whether you go into long-term care, their property can be sold and the mortgage can be repaid. And if you're in a relationship, there are two of you on the property deeds, and that's important on the property deeds, then it's when the second of you were to pass away or to go into long-term care. Now, it's very interesting with the UK population because we are property heavy. Our house is our castle. We like property. We're a nation of property owners and lovers. And generally speaking, when individuals come to me, particularly if they've come to me later in their life, my job really is to diversify their investment allocation away just from property and also into the stock market. There's nothing wrong with property per se. I prefer it to be your main home. I'm not a lover of rental properties. But when you have lots of money in property and no cash and no stock market investment, you are over diversified to one asset class. So we really need to balance that out a little bit and invest in globally diversified index funds. And remember, long-term returns on the S&P World Index, which is the Morgan Stanley Capital Index World Index. So it's like the FTSE, but for the world itself, is over. I think it's over 9%. If it's not over 9%, it's got to be bouncing around 9% a year. Take a bit off for charges, say 1% for charges and running costs and stuff. You've got an 8%, and for most of you, that's a tax-free return as well. No tenants to worry about, no interest rates to worry about, no mortgages, no fees, no boilers going, no calls in the night. It's got to be worth considering, guys. It is a very, very good. And the liquidity of an equity investment is fantastic. However, I also appreciate and understand and respect property investing. I've got a very good friend, Ashley Kane, locally, who's a fantastic property investor and a landlord, and he helps people source properties. He does a really good job. So I understand that and appreciate it, and I have conversations with him. So I'm not blinkered to it. But what I tend to find is when people come to me, they tend to be very property heavy. Okay, so you're approaching retirement, you're very property heavy, it's difficult to get out of. So particularly if it's your main home and they want to realize some of this value, they might want to realize some of this value. So one of the things you can do is you can take a mortgage out on your main home, and there are some providers who now offer it on rental properties. You take the mortgage out on your main home, you pay no monthly payments because the monthly payments that you would have paid are added to the mortgage, and then that rolls up over time, and then when you pass away or move out, it gets repaid. Now, virtually all, I'm going to say virtually all because I'm sure there might be an exception, virtually all equity release providers or lifetime mortgage providers also have a guarantee called a no negative equity guarantee, which simply means that if the amount you borrowed starts growing in value and exceeds the value of your property. Let's say, for example, your property value might have come down, or interest rates might have gone up, or the value, the borrowing might have been over a longer period of time, so it's grown to be greater than the property value. There's a no equity guarantee, which basically means that when you pass away or go into long-term care, there's no claim on your estate or your beneficiaries for any excess mortgage. Okay, so the house might be worth 100,000, but the amount you borrow might be 110,000. The lender just swallows that and takes that on the chin. Another thing to remember is that if there still is equity in the property, let's say, for example, the property is 100,000 and your equity release mortgage, when you come to your final day, is only 80,000, that remaining 20,000 will pass in accordance to your will. You do have one of these, don't you? That will pass in accordance to your will. So typically, for most of you, it will go down to your beneficiaries. Okay, so that's basically how an equity release or a lifetime mortgage, is the correct term really should be, works. It's just a mortgage, but you don't make any payments because the payments are added to it. You need typically to be in your late 50s to get these. Every individual lender has their criteria. But like I say to people all the time, if your outcome is to release equity from your main home, definitely, always, the most important thing is to consider moving. It's cheaper, it's simpler, it just makes more sense. So if you have a house, and let's say, for example, it's worth, who knows, £200,000, it could be £1 million nowadays, it's worth more than you need, and you ought to realise some of that equity. You sell it and you buy something for half the price, £100,000 or £500,000. That excess, when you sell it, is tax-free if it's your main home. Principal private residence relief in the UK means there's no capital gains tax when you sell your main home. So when you sell it and you downsize, that money's tax-free, goes into your bank, you can invest it and draw an income from it. It's nice and clean. Then your beneficiaries will inherit the property that you live in. And with inheritance tax rates now, £325,000 for a nil rate band. It's gone up to £150,000 probably by the time you're listening to this, as of 6th of April 2019. £150,000 for the main residence relief, or principal private residence relief, and that's going up to £175,000 the year after. For a single person, in a year's time, your beneficiaries will be able to inherit £500,000 tax-free. For a married couple, they'll be able to inherit £1 million tax-free. There are a couple of criteria you've got to tick along the way on that. Make sure it goes down to what they call your direct descendants, which is basically your children, your grandchildren. But for all intents and purposes, it's very tax efficient now, for people up to £1 million. Pensions are outside of your estate, so it kind of works. So it's a great way for you to release equity without taking a mortgage out. Just sell your property, move. However, sometimes clients will come in and I'll explain this to them, and it's just too much of a big deal to move. And I do respect and appreciate that. They've been in this property for 20, 30, 40 years, some of them. They've accumulated lots of stuff. It's accumulated up. They don't know how to declutter and move. There's lots of fond memories, maybe from a past partner or their family, their children growing up in the property. They feel like leaving that behind. Or maybe they're actually, the first time we do anything, it's a little bit nerve-wracking, isn't it? If you've been in something for 40 years, thinking of actually moving, the unknown, what's on the other side of that abyss, can be a bit scary. So it's just not for them. They just can't bring themselves to sell. So if they can't bring themselves to sell, then that's when I will introduce equity release, and I'll start talking to them about the pros and cons, and really try and get the family members involved as well. Make sure you're talking to the beneficiaries of your estate, because we don't want it to come to a shock to them if they're not aware that you've done this. So, it's not the first option. The first option always is to sell and downsize. If that doesn't work for you as an individual, then definitely it's consider equity release. But take advice, folks. Don't try and do this on your own. It's a big decision. I've been a chartered financial planner or wealth manager now for been practicing now for over 25 years, and even I would go to a specialist. There's a guy called Mark Harris who I use, and some of you have actually had the good fortune of working with him. He's a great guy, and he does my equity release mortgages for my clients. And if you'd like to be introduced to him, just ping me an email, warren@warrenshute.com, and I'll introduce the two of you, and then he can sort of take it from there. But it's such a moving market. Gone are the days where interest rates were so high and expensive. These products become a lot more competitive now. There's a lot more people wanting the money that's available. And also on the flip side, the providers are becoming a lot more choosy or picky on what properties they will and they won't accept, because they know one day they might take ownership of this property. They want to make sure they can afford to offload it or sell it and not lose out financially. So it's a relationship that's changed dynamics, really. Before, there were few providers charging lots of money, people going after it. Now there's a lot more providers, and they're choosing, and there's even more demand. They're choosing more specifically who they will and they won't accept for these things. But I'm going off track a little bit, but that's what an equity release mortgage is. Is it for you? I don't know. I don't know if it's for you. All I would say is, first option, really seriously consider and engage your family members. Typically before you get to retirement. This is a discussion process that should be starting maybe 5-10 years before retirement. We often put retirement plans, I'm looking over there because my office is over there. We often put retirement plans in place 10 years or more. We start saving obviously as soon as we can, but planning our retirement, I was with a client the other day who's planning to move down to Cornwall for their retirement. Now, this has been on the plan for probably about 10 years, and it's just coming to fruition now. So these things take time. Where do you want to retire? Do you want to be nearer your family? Do you want to be nearer your grandchildren? Do you want to be nearer the coast? Do you want to be nearer the cheaper property? What these things are. But consider, as you age, the amenities being around you, and transport is a very, very big factor and an important consideration. So I don't know if equity release is right for you, but engage conversation with your family, consider moving, and take advice. And like I said, if you want advice from Mark, just ping me an email. I'd be very happy to introduce you both. Why do people do equity release? That's the next thing, really, isn't it? Why do people take money out of their property when they're at an age where they don't necessarily need to, possibly? And some of the reasons why people would take an equity release mortgage out would be to supplement their income. We've gone through a period where annuity rates are particularly low. As I said at the beginning, we're a property nation, so we've bought property over time with our houses, our castles. So for some of us, we've paid our mortgage off if we're lucky. We get to retirement, our house is unencumbered, but that's our biggest asset that we've got. So, poor annuity rates, they need to supplement their income. So taking an equity release plan out on your property to supplement your income, and you can do that, and it can provide you with a regular income, or it can just provide you with a lump sum of money. My preference generally is for you to do so as a regular income as opposed to a lump sum. And that's because you only pay the interest on the money as you draw it. So it's not accumulating, and you have no investment risk with the capital. But everyone's circumstance will be individual. As we age, we might need to do some changes to our property. We might need to do some adaptations to make it more habitual for us, or habitable, not habitual, sorry, habitable for us as time goes on. So simple things like maybe stoning the garden, or taking out some trees, or possibly including a stair lift, or changing taps is a big one actually for individuals. I think as we age, sometimes arthritis comes in our fingers, not necessarily as we age even. And having easier stick taps as opposed to those hard ones that twist that way, making things easier, possibly converting one of the rooms downstairs as a bedroom so we don't have to use the stairs as time goes on. So adapting your existing property so it has longevity as you go into your later years, doing that way. We often work our socks off all our life, squirrel off, save our money away, pay our mortgage off, do our dues and things like that. And we miss out sometimes on the juice, the essence of life. We miss out on our original bucket list. So when people come in or inquire to become a client of Lexington Wealth, we have a phone call with them, and then we send out a client profile form, find a little bit about them. And at the back of that, it talks about their goals, their dreams, aspirations, and their bucket lists. And I forget the actual thing. Is like, is it something you'd like to do, absolutely must do, or you're okay if you don't do it, it's just on the list kind of thing. But having a bucket list, some idea of what you want to do, and often on that is this cruise, dream holiday, travel to Australia, travel to America, go to Africa safari, these kinds of things. So you may not have the cash or wherewithal to do it yourself now, but within your property you might. And sometimes people decide on an equity release to have those memories. That's one thing we can't lose, isn't it, as our memories, really. So we have those memories as we get older, and we can look back on in fondness of. So having a dream holiday. Not everyone who does extra lease is short of income. Maybe they've just got a big property and they may not have anyone to leave it to, or that it's not a priority. Maybe their children are doing well financially. Thank you very much. It's for me. So they might choose to buy a holiday home, a second home. So they release the equity from their current property and buy a second property as a holiday home nearer the coast. Always want to live near the coast. They like the home where they are because obviously they've got family around here, but they want to take a place down near the coast or something, or in the forest or wherever it might. Lake District, I absolutely love the Lake District, the Peak District. It's gorgeous. So they might release the equity there and buy another property. I would sort of strongly recommend you do all your figures in respect of running two properties. It can be very expensive, and whether you want to run two properties in your older age, but hey, it's your life, live it. It's up to you. It might be to buy a rental property. You release equity, buy a rental property. It might be to help or support your children. Maybe your children are struggling financially. We all know what it was like when we started out. The millennials talk about it all the time now. I was no different. Making ends meet at the beginning is difficult because you're on the traction. You're accumulating, buying things, setting things up. So a lot of capital outlay. It's tough. It's just like it is tough for a business when they start out. So maybe help your children just day-to-day financially, or maybe help your children or grandchildren onto the property ladder. So maybe they're not on the property ladder yet. They're going to inherit your estate anyway. Actually, a gift during your lifetime gives you pleasure as well as them pleasure. So you see them get their first home, the pride, the excitement they have from it, and you can do this often by releasing equity from your house. Remember, there's a cost to it. You don't pay the monthly payments, but there is a cost to it. So if you release £50,000, it's not just £50,000 that will get repaid when you pass away. It'll be £50,000 plus the accrued interest. But if that cost is worth it for that gift for you and also for the beneficiary, then that's fine. It's your money. Just make an informed decision. And that's why I say about going back, taking the advice when you do this and speaking to someone who I trust at least. Great guy. He's worked with all my clients. Like I said, he's done a number of extra leases for you. So Mark Harris, so just choose someone. It doesn't have to be Mark, obviously. If you've got someone then that's absolutely perfect. But just choose someone you trust. You might decide to move, but don't want part of the thing stopping you moving is the chain. So getting a buyer for your place and then selling it and then buying another place. You could release equity from your property, buy the downsized property, and then obviously have your property on the market for sale. Remember, houses sell better when someone's living in them because they look nicer. But if it works for you, and then when this property sells, repay the extra release mortgage. Now, a caveat there you've got to make sure of is, are there any early repayment charges on this equity release mortgage when you do it? And if they are, is it worth it for you? But if you're at this stage of life, and if these things are ringing true for you, you'll understand sometimes the cost convenience of doing this is worth the payment. If you're younger, or if you're thinking, actually, Warren, you're talking about all these things, and actually, is it really right they should be doing it? They should wait. We think differently as we age. And what's important is when we make suggestions for people, we try and get into their world. When we make advice, we get into their world. What is it they want? Not what do I want? What's the best decisions for them at this stage of their life for them? And everyone's unique. So that's why I'm talking very generically. But if you want to move, or it's quite important that you move and you want to go live nearer your children, for example, but the barrier of selling and buying is just so big for you in your mind, consider releasing equity to buy the second property and then marketing your property for sale and then repaying the equity release. So that transaction will be wrapped up once this property sells. You won't have an equity release. I go on about repaying debt, repaying mortgages and things. Some of you might have interest-only mortgages still and not sure how you're going to repay it. Some of you might have credit card debt or loans going into retirement. And actually, sometimes it's nice just to clear the slate and just get rid of that, so you go into retirement financially strong. Some people would like to do extra lease to do that, so repay their credit card, repay their loans, get financially straight, repay their existing interest-only mortgage, assuming there's enough equity in the property. So these are other things that you might want to consider. please, if you do that, make sure you're managing your day-to-day money correctly. Look at the bank account system that I talk about, because one of my concerns would be that if I'm not suggesting here, but if you are in debt because of poor money management skills, and if you have not managed your money in such a way that going forward you will stay out of debt, then you're just going to repeat the cycle. If you do what we've always done, we're going to get what we always got. And therefore, if you're in debt because you overspend, if you don't change that, you're going to be in debt again. You might have paid them off today, but in a year's time, 6 years' time, you're going to be back in the same place and possibly not able to go back and draw equity from your property. So they are the main sort of reasons why people will consider equity release. But there is another one that often is overlooked, and this is more of a strategic planning reason why people use equity release. And it's not necessarily people who are struggling financially who will do this. It might be people who have a very big estate. So I touched on the value that we pay inheritance tax on our estate over the nil rate band. The nil rate band for an individual is £325,000. In addition to that, you have the residential nil rate band, which simply means if you leave your property to your direct descendants, read that as children or grandchildren, it's a wider class, but typically grandchildren, then we have another, as of today, we have another 125,000. On the 6th of April, it goes up to 150,000. And then on the 6th of April 2020, it will go up to 175,000. So as of April 2020, we have 325,000 nil rate band and £175,000 residential rate band. Added together gives £500,000. If you are married or in a civil partnership, that is £1 million between you, because assets pass between husband and wife as long as you have a will, tax-free. Okay, so all the assets can go across to each other tax-free. So on second death of a marriage couple, there's £1 million. On death of a single person, have £500,000. Now, pensions typically are outside of the estate there. I say typically because there are some exceptions, so don't take this as gospel, but typically they're outside of the estate there, particularly you've got nomination beneficiaries on there. And if you have a trading business, not an investment business, not a buy-to-let portfolio, but a trading business, that attracts something called business property relief. So that's taxed at 0%. And if you have farmland or agricultural land, as long as it meets criteria, that's taxed at 0% under agricultural property relief. So if you have assets in excess of that, and typically when I talk to clients, they are ISA portfolios, bank account portfolios, cash bank accounts, that kind of thing, or other assets, maybe a second home, a holiday home, that kind of thing, these are all potentially taxable. So when the value of these assets for a married couple go over £1 million, you're looking at inheritance tax on the excess of 40%. Now that's a big slug of money, 40%. So one of the things that some clients decide to do is to gift assets away. So as long as you gift an asset away and live 7 years, that asset is outside of your estate. And with the 7-year rule we're typically familiar with, we talk about this tapering of the tax rate. But if you gift an asset away and retain no benefit in it, then after 7 years, that will be outside of your estate. So let's say, for example, we have a holiday home and it's in Portugal. I like Portugal. And we gift it away. I've been there so many times. I've done with that. I'm going to gift it away into the name of my children. I will retain no benefit from it whatsoever. I will not use it, no rental income, nothing at all. That now is in the name of my children. As long as I live a further 7 years, in the 8th year, that is outside of my estate completely, and then inheritance tax free. We can't do that with our house, can we? We can't do that with our main home. If we've got £1 million plus house and we've got other assets around us that take us outside of the inheritance tax threshold, we can't gift our house away to our children, wouldn't want to either, and not retain a benefit because it's our home. We live there, because that's called a gift with reservation. We're gifting the asset or reserving a benefit in it. So the challenge you have there is, one, we gift it to them and it's in their names, and their relationship, their marriage breaks down, and then the matrimonial courts are arguing over what was my house where I live. Okay, is it going to be owned by my daughter-in-law or my son-in-law or my daughter? You know, that's a worry, something you don't want in your retirement years. But also, where am I going to live? I gift it away. I can't reserve a benefit by living there because that makes full fouls of the rules. So where am I going to live? I have to move out. So that doesn't work. So anyone gifting property away, people sometimes do it to avoid, which we shouldn't do, avoid long-term care. it's just wrong. It's wrong. Don't do it. It's not right. Don't want to be putting assets like this in other people's names. We don't know what their financial situation. If they go bankrupt, get sued, might need long-term care. It's not just the elderly who need long-term care. If they have an accident and hit their head, they might need long-term care. So your asset is in their estate. Or if they matrimonial, they get a divorce and everything else gets all messy. Don't gift assets away like that. But one thing you can do is you could potentially release equity from your main home. So let's say, I use 100,000 because it's a round figure. There's not many houses these days you can buy for 100,000, but 100,000, you release equity from it. You can gift that 100,000. Let's say we release 70,000 pounds or 60,000 pounds. We can gift that 60,000 pounds away, either to individuals if we want those individuals to benefit from it, or into a trust. And then that starts the clock ticking 7 years. So we've not gifted our home away. We're living our home. We're quite right to live in our home, but we've gifted the cash or the value or part of the cash value of our home away into a trust or individually. And then that's outside our estate after 7 years. So there are ways of using equity release, both for the people who need support for income and also for those people who want to stay in their home, but actually try and transfer the value of this out of their estate. Now, remember what I said at the beginning. The first thing that I encourage everyone to do is seriously consider moving. That is the best option in 99% of the cases because it's cheapest, easiest, cleanest, and people understand it. This whole video and recording, or wherever you're listening to it, is purely based on those people who say, I don't want to, I can't, I'm quite happy where I am. What else can I do? And that's when equity release comes into its own. So you have all those reasons that we went through in relation to supporting income, helping others, second properties, adaptations to your current home, whatever they might be. And then we have this other area that might be for people whose estate exceeds the couple of £1 million or the single £500,000 and is really keen to avoid paying inheritance tax legally and legitimately. And one of the things they can do is release equity from their property, make a gift into a trust or to individuals if they prefer. And again, as long as they live 7 years, that money will fall outside of their estate. We've covered a lot here today. I hope it's been of use. It's a different environment, different surrounding. I hope that's been nice. I hope it's been clear enough sound for you all. Please leave me some comments. I've had some great emails and stuff. People email me in and thank me and stuff like that. If you'd like to speak to Mark Harris, drop me an email, warren@warrenshute.com. If you have any comments on the shows and what we cover, again, warren@warrenshute.com. And if you would be kind enough to leave me a review, that'd be great. You can listen to this on the go now on iTunes or all the other podcast stations. Leave me a review. Tell me what you think. Only nice reviews, by the way. We don't want anything not nice. And 5-star reviews would be great to start off with. Give us some sort of momentum. My outcome isn't to become a podcaster. I don't want to compete with the other podcast individuals out there. They do a brilliant job. My outcome is just to give you another medium to listen to what I'm saying, just to pass on the information. So thank you so much. Have a great weekend. The sun and the weather is with us, and I will catch you next week. And Paul, get well soon. Take care.